This week we are going to be building up to a discussion of all of the different aspects of financial planning. So I want to start out with sharing a piece that gives financial advisors and clients all of the updated federal tax numbers for 2021. There are a number of things in the federal tax system that are indexed to inflation, and those numbers change every year. So go to our website, value-ability.com, under the content tab, and there is a link to the 2021 federal tax updates. Has lots of different information here. The change to the tax brackets, the change to the standard deductions, long-term care, premium, deduction amounts, alternative minimum tax numbers, just a whole raft of things that update each year, and we have to keep updated of those numbers. And this is really one of the big differences between trading, investing, and planning, which is the title of episode 46 of the Value Ability Podcast. Value Ability Podcast is for financial professionals, business owners, and anyone interested in financial planning, business leadership, and personal development. We believe that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. My name is Danforth Fleek. I was a financial advisor and product wholesaler for 20 years, and I'm joined each week by my co-host, friend, and mentor, Philip Simonson, who is in financial services for over 40 years as a financial advisor, field leader, sales trainer, and has had a host of senior management positions covering areas such as advisor development and field operations. Now, Philip, one of the jokes we had early on in doing the podcast was that we would get to this point of the podcast and have a short little conversation. And just like a verbal tick, we noticed that being Minnesotans, both of us, we almost always talked about the weather. And so on our agenda now, it says, do not talk about the weather, talk about something else at this point. However, at this point in February, I look at my weather and it is a high of 1, a low of -6. And when I want to feel better about myself, I say to my phone, Siri, show me the weather in Cook, Minnesota.
And what did you find?
-9 high and -20 low. So
I had 30 below this morning without wind chill, and we had
Wow.
strong winds yesterday. And I've lived here most of my life, and I've always said anything -20 below, after that it's just all relative. You can't tell the difference.
It's just freaking cold.
It is freaking cold, and you know we did. Oh, we could be setting a record where it's like 8 days where we don't get above, 0.
Yeah.
So, I remember when the boys, we moved back from England, I said, we had this weather and pattern, now they call it, a polar
vortex.
And I said, all right, I took a grapefruit and I took a banana. We're going to leave them outside tonight. Now, tomorrow morning, I've got this 2x4 and I have these nails. And how many do you think I'm going to be able to pound this nail into the 2x4 with the banana and the grapefruit? Oh, no way, Pop. No way. Okay. Was able to do it with both. Then I said, all right, let's take boiling water.
You did the hot water. Yep.
Tell the people about the hot water, how it works.
You take boiling water and hot water and you throw it up in the air and it freezes by the time it hits the ground. It turns into snow, basically.
It just evaporates right in front of your eyes and it just turns into a cloud of, snow and yeah. It's amazing. It's cold. So
Our unofficial state motto, of course, is cold enough for you. This point in the year. So I just thought it was funny that after spending months trying to avoid talking about the weather, the only thing I could talk about when it's single digits is the weather. But then again, makes me feel better that there's somebody worse off than me. So
since we can laugh at ourselves here, and another one that you might know you're in Minnesota or you're talking to a Minnesotan when they have to say goodbye 3 times before they get to the door. They shake your hand. They won't hug you. Good Norwegian, Swede, Scandinavian. That's a rarity. Woo, woo, hug. Whoa, whoa, wait a minute. Boundaries. But 3 goodbyes. Oh yeah. And the church, I'll have a church cup. Well, that's
3
half.
offers for coffee. Yep, always 3 offers.
And only
no.
Church cup is half full. Just a half full. Just a half. Church cup, half full.
Well, if you're gonna make some.
Yeah, exactly. All right, Dan. What are we talking about? I know you're gonna kick us off.
Yeah, absolutely. You can find the Valuability Podcast on Apple Podcasts, Spotify, Stitcher, and TuneIn. We also have a YouTube channel. Search Value-Ability to find us there. Value-Ability.com under the Episodes tab is where you find our episode player. Wherever you find us, please like, review, subscribe, and share. At this point, we've kind of transitioned into subscribing is really the best thing that you can do for us. So if you're listening to us on a consistent basis and have not yet subscribed, please do so. If you'd like to connect with us, email info@value-ability.com. Again, that's info@value-ability.com. Or you can find us on social media, Twitter, Instagram, and Facebook. Links are all at value-ability.com under the Contact Us tab. So obviously, well, maybe not obviously, but depending on when you're listening to this, we are coming off a couple of weeks in the stock market where primarily GameStop, but also several other what they're calling meme stocks have caused a big splash, and a big splash across media. I listen to, I think I mentioned a couple of times that my primary sports radio is actually the biggest English talk radio station, sports radio station in the UK, Talk Sport, which I listen to on the internet and on an app. And I know it's big when their 30-second news break in between English sports, something gets mentioned that's going on over here in the States. And it made it that far. That disruption in the market has been really across all forms of media. And it just got me thinking about, along with hearing different platforms, people talking about the whole saga of GameStop and having, different opinions of it from the standpoint of kind of the layperson. One of the other radio shows that I listen to, they've been talking about it pretty consistently. And it just reminded me of the gap in public education, financial education, around the differences between what is trading, what is investing, and what is planning, and why are they different? Why is it important? And also, why are they all individually necessary? I don't say this, we are planners first and foremost, but our planning does also include investing, and it does also include at times some trading. We're not by any stretch of the imagination traders, but our version of planning really does incorporate all 3. But there are also versions that don't. And so I just thought it was a good topic for this exact time. I think we can talk a little bit about, what's going on with GameStop and some of the controversy there. But I just took a moment last night and wrote down, for me, without looking anything up, I didn't go on dictionary.com. I just sat down and I was like, I'm going to write a definition of each of these terms. And so I'm going to start off with that, and then we can branch off from there. Trading. Buying and selling stocks to take financial advantage of short-term price fluctuations, not based on perceived value necessarily. Sometimes it is, but not necessarily. Sometimes it's based on other things. Investing. Purchasing stocks or other investments based on their perceived value and for a long-term appreciation. And then planning. A holistic, all-inclusive approach to the financial well-being of an individual, family, or entity. So I'll pause there and just kind of let you respond to that in a wide array.
Well, no, I like how you're teeing this up. And I'm going to just take a little different approach to it. I first just confirm I agree with everything you said and how you defined it. Where I see this is in the new world and going forward, I think you're always going to have typical investment management, which I would put in trading inside that, and there's always going to be the asset allocation, the Monte Carlo, all that stuff, and then you've got financial planning. Then as you described, the holistic approach, it's goals based, determine your goals, work backwards, then to be, and build out your plan to achieve the goals and plan for the certainty of uncertainty and making sure you're looking at risk management and cash flow, etc. Then here's where I think the difference is, and I know we'll get to this today too, but the new piece to this and what's, kind of scares me is the behavioral advice piece and what we've seen in the last 2 weeks and what it can potentially mean to first-time investors that got involved. Now, and I want to just go on the record right now as saying I'm all for the what's going on. These young investors, first-time investors coming in, I think they got their not what we've seen here is a heavy concentration of, with the tech platform, digital platform, and these chat rooms. You marry that with the pandemic and being socially isolated and the need to feel, you got to participate. And more people are working from home. They've got more time. It was just a natural, I think, occurrence. But I think the best thing that can happen here, and I want, is that there becomes a level playing field in this investing, if that's the way you want to go, or you described, Dan, trading. But I want to come back to that, and I'll turn it over to you here. But before we do that, I hope that then, because it does occur where we don't lose these people. They do get more tools and knowledge to be able to continue their investing, because right now, I think you and I shared this before the meeting or this podcast, the top 10% of people or households in relationship to net worth, they hold 80% of the stocks out there. So we want a more level platform, and this will help, but there's some risks I want to come back and discuss in greater detail. But
yeah, I think the first thing to talk about as it relates to the GameStop saga is that you've really got two layers going on here, right? So you've got this Robin Hood, the
yes.
name itself, right? Stealing from the rich to give to the poor, the legend of Robin Hood.
Mm-hmm.
And then you've got this added layer of tech giants, the Elon Musks, and I can't remember the name of the guy who's a part owner of the Warriors, but he's also a big tech VC guy.
Plus Dallas, he's
you got Mark Cuban throwing information in there. They don't like Wall Street hedge funds, right? They don't like this shorting activity, right?
Mm-hmm.
And my initial reaction to that is, those guys aren't on your side either.
No.
Right? Like, they're not on the little guys' side either here. These are big guys fighting with big guys, right? And one of them using the little guy as a weapon. And, okay, like, everybody's free to do whatever they want, right? Like,
That's right.
I'm not going to get into my politics, but I'm as much of a, individuals are free to do what they want within guidelines of not hurting other people than almost anyone out there. But the really interesting thing to me is that I just read an article this morning that said some unnamed, top risk management officials at top Wall Street firms are looking at this and kind of chuckling to themselves and saying, well, yeah, Robin Hood, if you weren't thumbing your nose so hard at Wall Street and all these established things that we do, you would have been prepared for this, because yes, there were ways to have known that this was going to occur and what was going to happen on the back end. And the very fact that they are this kind of, we're more tech than we are Wall Street, led to them having to, running into a cash crisis and then having to limit stock trading, which is now making them look like the bad guys. I just thought that aspect of it was really, really interesting, in that some of the risk folks on Wall Street are now coming out and saying, I saw this coming a week or two before, and if you had had the right professionals in the right place, you would have been prepared for this.
Well,
yeah, that's also just a large part of this too, right? Is that in the tech world, you put out an app, people use it. If they misuse it, it's not your fault. And one of the points that the journalist made was, when you take control of people's money, the rules change, and there are lots of rules, right?
Oh.
And the rules are there for a reason. They are there to protect people. Now,
we went back to the 1940s Act here, and Dan, you're just, the other thing too, right. Robinhood, I have one son who uses it for trade. If you ever looked at that app, and they got in trouble just last quarter again, where someone got, a young man ended up committing suicide. They know exactly what they're doing with the colors. It's almost like a casino. And then they
gamify,
and right, and they know how to hit the dopamine and create, all the excitement and positive emotions, and the dopamine gets released. They know exactly what they're doing. So there is some responsibility here. But the other thing, what helps drive this, commission free, and so then people think, well, this is commission free. The reality is, there are charges on the back end here, but they're not aware of it. And
commission free does not mean fee free.
Thank you. So we got, we'll talk more about that later, but I just wanted to put that in before we jump off of Robinhood. There is some social responsibility here, and,
sure,
and it's geared, just like you said. We're here for the underdog. We're going to take from the rich and give to the poor, and yet they're feeding off the uneducated.
Well, and the bottom line of it is it's not. The reason why this is difficult is that it is not clear-cut. When does protecting someone from themselves become limiting their opportunities is really the question, right? Like, you guys have rules in place to prevent me from hurting myself, but then that sets me up to not be able to take on the big guys. I totally get that, and I'm totally open to discussions of that, but the reality is, I think I actually heard this from you, although I might have actually heard it directly from him. Miles Gordon, our original CEO from Financial Network back in the day, used to say the only more heavily regulated industry in America is porn. And there's a reason for that. Right?
Well, it's been around since the beginning of man. And so, but yeah.
Finance and sex, right? I think those are the two things that have been around for ever and ever and ever. And they're also rife for abuse, right? There are situations where people can be vulnerable. And so this is what I'm struggling with at this point in the kind of the discussion of all of this, is that you've now gotten people falling into this. Oh, well, of course, Robinhood just shut down trading when their big hedge fund benefactors started to get threatened. And it's not that clear cut. And I'm not actually sure where I fall on that. I probably fall on we need to take a look at exactly what happened and exactly how this decision was made. And if there was any potential impropriety on that side, take some action on it. But it does seem like they made a business decision to protect their business. It's better than Robinhood having gone out of business and everybody
exactly
having to try and reclaim their funds from a company that has collapsed, right? Yep. That's obvious.
Well, they're shorting, so they had to come up with money too, and so they're taking out
Well, they
loans
were
on
going
that.
against most of the retail investors were going against the short, but
Correct.
they were using options, and
Thank
that was
you.
causing Robinhood to have to
That's
buy
on
the stock
margin,
to help
exactly.
cover that. So yeah, it's very complicated. Like it's not as clear cut as it seemed. Like I just read an article today that was lawsuits against Robinhood, they're bad guys.
I don't think that, and I don't want to see him go away. I'll just have I'll turn it over to you, but here's my last couple 2 cents on this thing, Dan. And I was doing. I think what you see. You corrected me. I said this thing is just uh, this whole mania and all the towards just. I had a son. We were painting. He's just bought investment property, and we're tearing it down during the last couple of weeks. And he was going to his phone and getting all excited, seeing what Elon was saying and what they're saying on all the Reddit and the chat rooms. And here's what. So it dawned on me. I said, this thing is just like I'll say it, and then you'll add some clarity. But the markets are like Red Bull and Red Bull and the Jägermeister, and the Red Bull is the energy and the intensity that we're seeing, the Jägermeister, well, that's the questionable judgment that we're getting once you start taking this thing. And Reddit, they did a survey. I just read this as well. Reddit did a survey, a couple thousand, they did a survey of people who use Instagram, Reddit, and Facebook, 2,000. And here's what the people said, and this is what we need to take from this. And they say, look, we just want to level the playing field, but we feel like we're not, because this is being, it's a new paradigm and it's more digital driven, that they don't have the necessary tools, the same class of money managers, they need to, they don't how to diversify their investments appropriately, and the tools to help them do that. I think we're going to have to, because they're just learning from each other. They're on these, chat rooms, and they're learning from each other. So at some point, we're going to have to, I think the lessons like you're describing, they'll go back and analyze this thing, and there'll probably be some more regulations that are going to come into play that hopefully helps level the playing field. But I think the smart people will realize, hey, wait, we have this group of people now who are out there and they want some more information. They want to start investing on their own. And I think that investing on their own, what we're going to see more of is the SMAs, separate managed accounts will be something that could go. But my big thing and big concern lastly is we got the barbell, and you got the two weights at the end. On the one weight, on the one end, you got you got a positive, and there's a lot of people who made a lot of money. You just hope that they realize they have to pay taxes on this money and they save some of it. But also with those people who have a positive experience here, going back to what you and I have taught on these podcasts before, the behavioral advice, I'm afraid they could have overconfidence bias. So they think they're going to be able to do this a lot. But, that's the free market society. They're going to get burned. They'll learn. But on the negative side, though, those who didn't make any money, because someone's buying and someone has to be selling, I hope that we don't chase them away, that they'll never invest again. Because this next, and they're only going to keep their money, the millennials, in savings and checking accounts. And we've talked about that and what happens there with the silent partner and the silent embezzler. They're going to lose out and not build enough equity and participate in this great economy of ours that's done so well for, at least 150 years. They're going to participate if they want to ever have financial independence.
Yeah, I think if we look back historically, the last generation that really just totally rejected investing and never came back was 1929. Right? Like there was
took 15 years to come back. Those who lost. You're absolutely right.
But even worse than that, the there were people going into banks thinking they were putting their money in the bank, and the bank was selling them stock certificates that they thought
You're
were
right.
CDs. This is the whole reason for FDIC, the whole
Correct.
reason for the 3 knots and a risk. For those of you that don't know, it's not an investment, not insured by a government agency.
Which the FDIC for the 100,000.
Right. All of those things are
No
required
guaranteed
because
return
of,
on it is your
right,
other
no guaranteed return. Yep.
third
And then
item.
the risk is possible risk of loss of principal.
Correct.
That's the last time that I think we've seen a that didn't happen in the early 70s, right? The last other big down market was the early 70s, 71, 72. There was just a giant wave of people that stopped investing after that. And we've talked about it in the wake of the financial crisis, but I remember hearing that in 2010, 2015. Oh, there's going to be this whole string of millennials that saw their parents' IRAs fall in half, and 2008 wasn't the Great Depression, right? Like that's when I stopped listening to media, was when I kept hearing it's the next Great Depression, as I had to walk a mile to get into Kmart.
Turn to
Right?
Great
Like,
Recession.
right.
What's the difference between a recession and depression?
Right. When you
Remember,
lose your job
it's a
versus when
recession when
your
your
neighbor
neighbor's
loses
out
your
of work.
job.
It's a depression when you're out of work.
Right. Right. But again, like, so I'm not super worried about it driving people away, especially people. If you jumped into something like GameStop with your life savings, like, most people, I think, were doing this with a reasonable amount of money from
Oh,
what I
Dan,
gathered.
the $600 stimulus check. Well, it worked. We
Yeah, I
haven't
also
got a
think a little
spending.
that's a little bit overblown too, right? That was the pick yourself up by your bootstraps hedge fund manager
Yeah.
response, right? When he's like, "Oh, it's all this stimulus money and making it unfair to me." Like, maybe you need to figure out how to pull yourself up by your bootstraps there, billionaire.
Yeah.
Like, okay, whatever. Like, I I think people were also putting other monies into this as well. But my bigger thing is, like, trying to get people to understand that, like, a $400 value for GameStop was never sustainable. That wasn't the end game. The end game was to ruin the hedge fund managers.
Correct.
The stock price was always going to come back down. And so all of these small people thought, oh, this is going to keep going up forever and ever and ever. That wasn't the game. The game was to push it up until the short sellers lost, and then abandon the stock and let it go back to, like, this was no, like, gallant, like, effort to save GameStop. Like, this
No.
was a war between tech people and Wall Street, and
That's
the
right.
little
Yeah,
guy got
little,
involved.
yeah, and then again, because of, I think, again, you have these different forms, which are great, and I just hope, and you started off with this, Dan. It's about, again, teaching people how to think. That's the hardest thing that one has to do, and it's the education. And if that ends up being the byproduct, and we help people, and we meet people where it's, and how they learn, then we're winning. Too many times in our industry and how long I've been around, we think it's more uh, it's driven by the advisor and the value add that the advisor is providing the clients. This is going to be, I'm hoping the byproduct of this, it's going to be more customer centric with a focus on how they're perceiving the value. Because I, again, think our way, our old paradigm, or my people's paradigm, who are advisors in this financial, is really, the focus was on the value add that we're delivering to our end clients, our clients, as opposed to focusing on what truly the user wants and what they see as value. And I hope this younger group tells our industry loud and clear, here's what they see as value going forward and how it's going to help them. And I think I've got faith. I think it'll work.
Yeah. Well, I think that the overarching discussion here is how much of these three different things, trading, investing,
Mm-hmm.
and planning, can be digitized. Because the further you go one direction, the more it becomes an intensely human process, right? The concept of financial planning is, just by the definition that I gave, holistic,
Right.
all inclusive. Like, these are not things that a robot does, right? These are things that humans do. They interpret and give reference to things that are wide ranging and very diverse. And you are often in the financial planning process making a decision with limited resources. Okay, I have this much money. I have these risks. I have these goals. How do I balance all of these things? And I often talk about it, especially when you get to the income planning side of things. I say, look, income planning is like putting Humpty Dumpty back together. Like, you just move the pieces around until they look kind of right. And then you test that and you see how you feel about it, because there's not ever one true answer to, is this right? Because the bottom line is, especially around our concept of planning for the certainty of uncertainty, you don't have any idea what's going to happen. I would always say this to my clients when we were doing retirement income plans. I said, retirement income planning is super easy if you can tell me one thing: when are you going to die?
Mm-hmm.
You can't tell me that. So it's not going to be easy. Let's just get that out of the way. Like, it's not a formula. It's not science. This is art.
This is a social science. It's not
It
an
is.
empirical science. Absolutely. That's financial planning. And I truly believe this. Tying it all together, and I'll let you expound on it. But look, go back to other earlier podcasts, and I'm just going to just repeat it. You live on 70% of what you make. Then you take the other 20%. That's for your, cornerstone 2 and 3. Your cornerstone 2 is cash reserves, what you're going to need in the next year or two. Um, and then your cornerstone 4, that's your last 10%. And you can do, it's okay to exceed these goals, and maybe you can live on less, but that last 10%, that's what you're going to invest for the long term. And that's where you're going to invest into things that are you have at least 5+ years ahead of time. And of that 10%, you should be willing, if you want to do speculation with what we're talking about. This is more of the trading and more day trading and speculative, and you're betting on where things are going to go. You should be, don't put at risk more than 10% of your 10% that you could lose within 24 hours. And otherwise, you're this you and you're setting yourself up for big time failure. And I like, if you're doing the planning, tied into this thing with the goals, and you take that long term approach, people will be okay. If they still want to do the speculation, it's 10% of the 10%.
It's always good to start with a rule of thumb, but also the rule about rules of thumb is that as soon as you actually get down to the details, the rules of thumb no longer apply,
So,
right?
well said. I always tell look at your thumb, Dan. Yeah, look at your thumb, Dan. I used to tell my clients, and I put my thumb up, and I'd say, "See your thumb." Rules of thumbs are different for everyone. But
Right.
again, fact is, they are rules of thumbs, and it's a great place, as you said, to start from there,
Yeah.
and then go.
Right. But I think this is the challenge now for our generation of financial planning, the end of the boomers into the beginning of Gen X, is to take this process and extend that front porch the best way that we can. Because simply throwing up your hands and saying, well, yeah, we're just going to have to keep doing it the way we're doing it, and millennials are going to have to adapt, isn't the right way to go about it, right? Like, this is my point here, is that, yes, it's an intensely personal, very detail specific. I joke all the time, all of my answers on the answering websites that I am on always start with some form of, well, like just about every answer I give on this site, it depends, because I don't know your details and you've
Right.
given me 2 pieces of information. So I'm going to give you some general thoughts, but the real answer is sit down with somebody that knows what they're talking about and give them all of your information, because it could change drastically depending on a bunch of different information that you haven't given me. And so I think the big challenge is to find a spot between the planning info that's out there in that Reddit space is, you don't need financial advisors, stuff it all in index funds and go away. Okay, but that's investing. That's not financial planning. Like that literally just scratches the surface of that. And it's, don't buy insurance. You don't need it. It's always a scam. And so I think there is a huge space for our industry to reach out and fill part of this and say, hey, you know what? Let's take this and start moving it beyond. I mean, that's what this podcast actually is, right? Like, if we think about it, most the podcasts that are in our space are just diamond hands, rocket ships. Let's talk about stocks, and that's not what we do. Like,
we're not product oriented. So,
right,
and because in this industry, I used to sell mutual funds at 8%. Then I went to 5%. Oh, Chicken Little, the sky is falling. Then I went to 2% for advisory. Now that advisory's down. The Vanguard's got a 35 basis points. You know what? You can do an index. You can get an index S&P 500 ETF, low internal costs, with 3 basis points, 3 basis points, and you got proper, you'll have diversification. And there's people who've made a lot of money in that in just the last 5-10 years. That just and so what I'm going to stress is, these investment products, they're going to be there, like these SMAs I described earlier, separately managed accounts, that these younger people can use and want to have more control. But what you're going to need is where you were going, Dan. And I think if I was in my 40s and late or 30s as an advisors, and I know this, the millennials are going to be inheriting a lot of money over the next 10, 20 years. You're going to have to help them, with the other things we're talking about, that holistic approach, doing the proper planning, making good decisions during times of high competing emotions, tax strategies, estate tax planning. You're going to have to add value that way, and most importantly, the value that they want. It's going to be driven by them.
And how, right? Technologically, also
Thank
looking
you.
at how they want
Yes.
to be doing it.
Yes.
It may not
That's
be
crucial.
through an app, but looking at doing it through video, looking at doing it through web conferencing and in different ways than the traditional. I've really transitioned into being an old guy. I prefer to go in. Like, if my financial advisor, he's in North Carolina, but if he were here, I'd go into his office and just sit there and talk, because I'm an old guy now, right? And I like having that contact. I get, when I was younger, I didn't understand that, right? Why does the old guy keep coming into the bank every day? It's because he just wants to talk to somebody.
Bricks and mortar. It was security, peace of mind,
right?
And they wanted to see the whites of the eye. That's how they were raised. This group.
Well, it's also just social. I wasn't raised that way, but I still like it now. As you get older, you want something to do, right? Whereas when you're a kid, you're out all the time, and you've got all that already, so you don't understand it, right? So like reaching out in those aspects, I think, is going to be pivotal. But that is going to wrap up our main section for this week. I do want to get to our article review because
Sure.
I think it's a really interesting topic. It overlaps actually a little bit. New Silicon Valley perks, childcare, financial planning, and therapy. Go out to our website, value-ability.com. Under the content tab, we'll post a link there, as well as on Twitter and Facebook. You can find the links to those either on those sites or under our contact us tab at value-ability.com. Here's the thing that really leaps out to me about this concept. Number one, I just don't like things getting sucked up into company benefits. I think it's one of the worst things that has happened to healthcare in this country is that it has been tied to company benefits, and that has removed all choice from the end user. There's zero choice. The minute I gave up on company sponsored healthcare and just went out and got my own, I became a much happier human being. I have a lot more control over it. I know exactly how my healthcare works now. And I don't get these weird surprises. I probably haven't told this story, but I had surgery on my toe, I think maybe like 2008. I had the platinum plan. It cost me $30,000, right? I was paying $400-500 a month for health insurance, plus my employer was paying the other half. So it was close to $1,000 a month. Then I go off, I get on a high deductible plan. I have Achilles surgery. That was actually right before I came back to work with you for the second time in 2014. $12,000. Even though it was 60 grand total, I paid less on my high deductible plan for my second surgery than I did for my first surgery. And that was a point where I was like, this doesn't make any sense. Like, what the heck is this company plan I'm paying $500 a month for that I end up paying $30,000 for a less invasive surgery? The Achilles was a much more invasive and involved surgery. So my first reaction is I'm not crazy about things being company benefits. And my second reaction is exactly the opposite, which is anything we can do to get more financial planning in more people's hands is okay. And then my third reaction is probably in the middle, which is it's about implementation, right? Because this could be implemented in a way that's just awful, right? Here's the only financial advisor that you can use to get this company benefit would not work for me. And that's the way healthcare works, right? With companies, it's here's your health provider, pick one of their three plans. And actually the three plans thing only ever started when Affordable Care Act, right? Before that, it was usually just one plan, right? Like I don't remember having a choice of plans before the Affordable Care Act. So how that gets implemented, if it's, hey, here's $1,000 that you can use to go to any financial advisor and, have them send us the bill and we'll pay it, I'd be fine with that. But if it's, we're going to have one financial advisor come in, that starts to reek of conflict of interest to me, because I'm going to guess that financial advisor might have something to do with knowing somebody in that company. I don't know. Usually it is the case, right? So those are my initial thoughts. I'll stop yammering and let you respond.
Oh, well said, Dan. The thing that stood out for me when the job search site, they Indeed, it's called, conducted a survey of 1,000 job seekers at the end of last year and asked about the future of work. 43% of the respondents agreed that the lines between work and life for most people have become permanently blurred. So it's all about this balance, and that's always going to be a struggle, I think. And these corporations trying to, you get more and more people having, in the article too, Facebook goes and said in May, it expects much of its workforce to remain remote on a permanent basis. And again, we're talking about Silicon Valley, and they're looking for the best of uh, recruits to come work for them. They're going, this just finding out different ways they've got to compete to be able to keep these people. But I think the struggle, in my opinion, is again, is that balance, and corporations are going to have to help these people get better balance, and because I always found just as a struggle. My great aunt would say, about my great about my grandfather. Ab, he used to say, well, he was a good father but a lousy provider. And I think if you have children, and that's always the struggle, um, being a good provider and being a good parent. You gotta work on that balance, and I think knowing what your values are, if family's a top value for you, lining that with your goals, and then making good decisions around it, that's the most important thing.
That's
Uh,
really interesting because I would say my dad was an excellent provider, but a lousy father.
yeah, isn't it? I mean, it goes one.
Right?
It's tough. I was a better provider than father, I would suggest, for a while, because I put work first. Right? The old traditional, value of work. And my role was to be a good provider. I left on Mondays, came home Thursdays. Dubious badge, a million miles just on one airline, American Airlines, back in the mid '80s. Where's your father? They'd look up at the sky, and point at a plane. He's up there. They thought I was a pilot, Lisa would say.
Right. But then when you stopped traveling, they were like, why are you here all the time? Right.
And oh, you don't have to go to the teacher conferences. No, 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 you don't have to go, Pop. But boy, yes, I do. I got to show respect out of to the teacher. And what I truly believe, and we've joked on this last time, with Aaron, people still do what you inspect, not what you expect. And it was never ceased to amaze me. As soon as I got home, what did the teacher say, Pop? What did the teacher say? Why did you said it really didn't matter. I didn't need to go. So I just take it as a balance. I don't have the answer for it, but I think if you go internal and figure out what's important to you, what those values are, and what your goals are, it'll help you in making good decisions. Because at the time you get to age 40, it comes down to people and place. Then it's
Right.
work.
Well, that's the next step, right? You did it with me. The first thing you did, what do you want for yourself? The
Yeah.
Woody Whiffy process. As an employee, you sat down and were like, no, we need to figure out what you want to do. Which at 22, I was like, why is this guy asking me what I want? I don't have any idea what I want to do. But really, it was kind of the groundwork for starting to at least think about that. And so that, I think, probably would be an even better thing to have, right? Is as an integrated financial and personal coach
Oh,
of,
yeah.
hey, what do you really want to do here? Like, what do you want to accomplish? It's very interesting. I'm doing a little bit of work from a consulting standpoint on the project management side in the tech world. And so I'm reading a number of books about tech management, and very similar in a lot of ways to the financial world, but also quite different in how those things are set up. The tracks seem to be quite well defined, whereas in our business, it's not quite as such. And there are some tracks, obviously, but not nearly quite as defined. But yeah, overall, I think, look, as we said time and time again, anything that gets people thinking about financial planning and engaging with it is good.
Yes.
To me, it's all about the implementation of the individual plan and how that gets laid out. But hey, great that it is popping up. And if you are a business out there that absolutely consider adding some format of financial planning, even if it's just creating a relationship with a company, a firm, or a couple of firms that you give access to your employees to do seminars, things like that, and say, hey, come in and do a financial education seminar for my employees on
Generic,
a regular basis.
non-solicitary.
Right.
That's very good.
Right. So with that, we will wrap up for this week. If you have topics that you would like us to cover in an upcoming episode or questions for us, you can email us at info@value-ability.com. Again, that's info@value-ability.com. Or you can reach out to us through social media. Our Twitter, Instagram, and Facebook links are at value-ability.com under the Contact Us tab. Actually, I have a couple of great questions that we received in the last week that we will do next week. Wherever you find us, please like, review, subscribe, and share. And that next episode, episode 47, patience. We are going to do 3 more values-based episodes: patience, discipline, and humility. Our next episode we will have is patience. So check back next week for that. What other values would you like us to cover on the podcast? Let us know. Reach out to us via those formats that I just mentioned. As always, thank you for listening. Be sure to join us next week. And remember that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. This is a podcast collaboration, not a peer-reviewed journal or a sponsored publication. We make no representations as to accuracy, completeness, correctness, suitability, or validity of any information in this podcast, and will not be liable for any errors, omissions, or delays in this information, or any losses, injuries, or damages arising from its display or use. All information is provided on an as-is basis. It is the listener's responsibility to verify their own facts. You should be aware of the real risk of loss in following any strategy or investment discussed on this podcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this podcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this podcast. Before acting on information on this podcast, you should consider whether it is suitable for your particular circumstances, and strongly consider seeking advice from your own financial or investment advisor. The views and opinions expressed on this podcast are those of the authors and do not necessarily reflect the official policy or position of any other agency, organization, employer, or company. Assumptions are not reflective of the position of any entity other than the authors, and since we are critically thinking human beings, these views are always subject to change, revision, and rethinking at any time. Please do not hold us to them in perpetuity.